Hello class, this is your video lecture for chapter number 7 where we're going to learn the accounting for receivables, both accounts receivable that we've seen in past chapters when you sell to customers on account, and something called notes receivable. But before we take a look at the next slide, let's review accounts receivable. So when we have a sale, remember sales is a revenue account, and how do you record revenue? With debits or credits? Of course, it's going to be credits. So here we have a transaction number 1. We sell to a customer, and let's say we get the money right away. So maybe this is like a sale using a cash register. Cash is an asset. Assets increase with debits. Here's a debit to number 1, and here's the credit to sales. Now, if you want to increase your sales, maybe you have to give customers the option of not paying off right away, but borrowing the money from you and you collect it later on. So let's have a sale again, but this time instead of debiting cash, you remember that account we debit when we sell on account or on credit to customers? Remember accounts receivable, the topic of our chapter? So now we're waiting with this asset eventually to collect the cash. And when you do, that's a separate transaction, here number 3, but you're not going to credit sales again for that customer's purchase, because here you already recorded the revenue. What you have to do with the credit to offset this debit is to reduce this receivable, because now you've collected this asset. Reduce the asset. So over time you increase the amount customers owe you when you sell to them on account, and you decrease the receivable when you collect the money. But what would happen if you weren't able to collect the money? Well, of course, you would need to know how much that customer owes you. So right now, looking at this accounts receivable account in our general ledger, remember that group of accounts, we would know how much all the customers owe us. But we would need to find out each amount or the balance of each customer's amount owing to us. So there's going to be more record keeping we're going to see in this chapter that's required. Okay, again, we need to know the account balance for each customer, not just for every customer. Let me go back here. For each customer. And what would happen if you cannot collect the money from that customer or customers? We call that bad debts, the amount that you can't collect. Now that would apply only to sales made on credit or made on account. If you had a cash sale, you already got the money. You don't have to worry about collecting it later on like a credit sale. So here we have our company Barton selling merchandise to a couple customers, Webster and Matrix. So we learned to debit accounts receivable. This is the general journal entry. Debit and credit sales. We also learned in past chapters you would have another entry here. Remember the cost of goods sold, debit this big expense, and credit the merchandise inventory account, reducing this asset, increasing the expense. And the difference here between the sales price and the cost of goods sold would be the profit on this one sale. Likewise, the second sale would also have that journal entry. Okay, but we're just focusing on the sale and receivable in this chapter. So now if you post it to the general ledger accounts, you can see accounts receivable should increase by $19.50. Here a debit for $19.50 for the 2 sales. But this would tell you the amount owed to you, this balance here really. Remember, this is like the T, and here's the running balance. Amount owed to you by all your customers. And if you want to know how much each customer owes you, you don't have to go back to the sales invoice, but now what we should do is set up another ledger. Remember, this accounts receivable here is in our general ledger, keeping track of each the balance of each account in the whole company. But if you want to know how much each customer owes you, here's a new ledger called accounts receivable ledger, where each account, just like represented by a T, represents one customer. Here, Matrix's account. And debits, just like here, increase the amount customers owe you. And if I take the balance of each customer's account the total here using this schedule would match the balance in the general ledger account. Sometimes we call this accounts receivable the controlling account, and these here are called the subsidiary accounts for accounts receivable. So now let's collect some money from those customers. So here's the journal entry: debiting cash and crediting or reducing the customer's account. Again, debiting cash and reducing the customer's account, reducing the asset with a credit. So here accounts receivable is being reduced by 1,300, and that would be posted here in our general ledger account, leaving a balance of $650 owed to us by all our customers. But again, we want to track the amount each customer owes us. You can see those credits are also posted here, reducing the amount each customer owes you. And again, if you take the balances of each customer and add them all up, it should match the controlling account in the general ledger. If you want this type of detail, you gotta do more work here by setting up this new ledger. And sub-ledgers like this accounts receivable can be applied to any general ledger account. So if you remember, we had one big cash account back in chapter 6, and here this balance here would represent all the different types of money we have in our company. But if you want to keep track of each type of cash, for example, maybe you have one for petty cash, one for the checking account cash, another account, sub-account for, let's say, the change fund for your cash registers. If you add up all these balances, that's what we saw as the general ledger account. Yeah, general ledger. And these here would be like a subsidiary ledger for cash. So let's say that you want your customers to buy more from you, so you get more sales. Instead of selling them to them on account, keeping track of it through accounts receivable, you can allow them instead to buy with credit cards or debit cards, and that will shift the risk of collecting the money to the credit card company. Here it mentions risk of not collecting, and you don't have to investigate the customers to determine whether you should sell to them on credit. You leave that up to the credit card company whether they should be issued a card with a certain dollar limit. And for most credit card companies, not all, when you ring up a sale on your register with a credit card, that's pretty much going to be cash given to you or available to you right away in your checking account or something called a merchant's account. Again, the bank card is going to allow you to record sales right away, and the money is going to go into your bank account or merchant account, and you can spend that money pretty much right away like a checking account balance. But the bank is not going to do this for free. They're going to charge you a processing fee. So here we have an example of our company Barton. We're making a sale to a customer using a credit card of $500, and the bank or the credit card company is going to charge a 2% processing fee. So we ring up the sale, we credit sales for the full amount of $500, but the debit to cash is not $500 because the credit card company or the bank is going to keep 2% of that $500 or $10. So we treat that as an expense here called credit card expense, and we're left with cash of $450. And to a lot of merchants, this is worth it because again, you have access to this money right away. You shift the risk of collecting the money to the credit card company. You don't have to track whether you need to extend or not extend credit to that customer. You leave that up to the credit card company for this $10 price here. Now, let me go back here to that previous slide. So we got our cash right away, and this is true for most credit card companies like Visa or MasterCard or Discover Card. But the other big credit card used in the US is American Express. And in the case of American Express, when a customer, like here, $500 sales, 2% processing fee, these two accounts are the same. But notice here what they're debiting. Not cash, but an account receivable. So you gotta wait to collect this money from the credit card company. Looks like you're waiting maybe a couple weeks. Now you got the money and reducing the receivable. And the longer you wait, possibly they'll reduce this credit card fee. Yeah, that's true again for American Express cards. So let's say you go back and sell to customers on account using accounts receivable. And no matter how hard you try, there's going to be situations where certain customers won't be able to pay you off. Now, if you could identify those customers ahead of time before you sold to them, you would never sell to them in the first place. But you don't know that, right? So you're still going to have to sell and run the risk of not collecting. And at a certain point, when you know you're never going to collect anything from that customer, what you have to do is reduce the account receivable owed to you. You bite the bullet and admit now you cannot collect that money, and you take that accounts receivable off of your accounting records. And here it says there's two ways of recording that writing off or taking off or reducing the receivables. The first way we'll see is called the direct write-off method, which is generally not the preferred method, but used only for when you calculate your income taxes. Okay, this is the rule for income taxes. The accounting rule, the generally accepted accounting principle rule we're preferred to use, is called the allowance method. And we'll see how we calculate these amounts here. So first, the direct write-off method. So we identify our customer, our company, Barton, identifies a customer, Martin, that cannot pay us off here in the amount of $350. So right now, sitting in our accounts receivable is this $350 debit balance owed to us by Martin. No matter how hard we try, sending them a second, third notice, sending a collection agency to collect our money, they can't collect anything. Maybe Martin declares bankruptcy. Maybe the owners or principals skip town and you cannot find anybody to pay you off. Well, you don't have a good asset anymore, receivable, so you have to write it off. And that's the credit part of this entry here, reducing the receivable with a credit. Now the offsetting debit, I wish it was cash, and that's what we would use if we were collecting the money. But here, no money, but bad debt expense. We're writing off the receivable and charging bad debt expense. Okay, again, this is called the direct write-off method. Now, the bad thing about this direct write-off method, or why it's not preferred for financial statement reporting, is that this expense may not be reported in the same period, let's say August, or the same year as the related sales that created this accounts receivable. One of the accounting rules we learned was we want to match the sales revenue with related expenses to be reported in the same period. But because at the time of the sale, you don't know which receivables are going to go bad, you have to wait a while to determine that. The expense probably is not going to be in the same month, or definitely not in the same month, possibly not in the same year as the expense, and matching it with the related sale. So let's assume that Martin, comes back and says, "Oh, I can pay off just part of my bill. Out of that, was it the $350? You can pay off $200." So what we do is reverse the write-off. We had debited bad debt expense and credited in the previous screen, but here we reverse it for the amount we do expect to collect now, and now here's the amount we collect. Yeah, reducing, recording the cash, and now reducing this receivable that we had restored. Very unlikely, but sometimes it may happen. Again, that direct write-off method is violating this matching rule that we had learned, the matching principle we saw in a previous chapter, where revenue should try to be recorded in the same period as related expenses. Yeah, sales revenue, bad debt expense. But if you use the direct write-off method, these two are probably in different periods. Materiality just means that if this is small, if this is Manini, you don't have to worry about which method you use. It's only when the amount will affect the reader of the financial statement, then you have to use that generally accepted accounting principle method, which is probably the allowance method. Now, the allowance method is going to estimate at the end of the year how much we expect not to be able to collect. Okay, estimate. It's not an exact science, yeah? So we're going to estimate how much is going to be bad debt expense for the period and how much of the receivable is going to be collectible. So there's two different things we're adjusting here, yeah? How much is going to be an expense and how much is eventually going to be collectible. So here they just tell us we do not expect, estimating, $3,000 of our receivables to be uncollectible. So the journal entry is to debit bad debt expense for that amount and credit not the accounts receivable. The reason why we're using this new account called allowance for doubtful accounts is because we don't know which receivable is going to go bad. We're just estimating overall how much of all of the receivables, all of this $278,000, will be uncollectible. So we cannot write off any receivable. Instead, we use this account called allowance for doubtful accounts, a real long name. Here it says it's a contra, opposite of an asset, of $3,000. So here's the amount customers owe us. We know $3,000 of this will not be able to be collected or estimate to be not collectible. And instead of crediting it $3,000, we use this account right next door. These go hand in hand together. This contra asset to this asset, increasing the contra asset by $3,000. So of this $278,000 owed to us, we do not expect to collect $3,000, or we do expect to collect $275,000. Both assets and contra assets appear on our company's balance sheet. So if you take a look at the balance sheet, here a partial balance sheet, of course you have cash, and the next best thing to cash is the right to receive cash or accounts receivable for the full $278,000. But then right after that, we subtract out the allowance for doubtful accounts. If you remember on the previous screen, this is a debit balance asset and this is a credit balance contra asset. And when you combine debits and credits, you never add. You always take the difference to get this $275,000. Again, the amount owed to us, $278,000. The amount we don't expect to collect, again an estimate of $3,000. And the amount we do expect to collect, $275,000. We do this journal entry here as an adjustment. If you remember, adjusting entries are recorded at the end of your period. So now we can update our balance sheet as of the end of the year. Now, how do you calculate out that amount to journalize? We were just given to us in the last slide. Well, there's two different methods to do the calculation. One is called a percent of sales, and the other is called a percent of accounts receivable. Under this second method, there's two sub-methods of calculating the amount that's not collectible. Let's take a look at the percent of sales method. So what you do is take a look at the sales you have for the whole period, be it a month or a whole year. Better yet, you should look at the credit sales. You don't look at cash sales if possible, because you already got your money for cash, right? Or we're trying to figure out is the amount that's not going to be collected. And you have already collected the cash sale amount. So credit sales, or better yet, if you remember, sales can also be reduced by sales discounts if the customer pays you off early, and sales returns and allowances if you reduce their bill to get net sales. The best figure here for the year or period would be the net credit sales. And what you're going to do is multiply that by a bad debt percentage. Now this percentage, you don't have to figure it out, but the company, based upon its past experience, based upon a trend, would use that amount they've seen in past periods, a percentage. And when you multiply these two amounts, that's the amount of our bad debt expense for the year. In this case, they're using 0.5% based upon their past experience. In our class, you always will be given a percentage here. You don't have to figure it out. You have to go through this calculation, but you'll be given a percentage. So here's our credit sales for the year. Timesing that percent will give us the amount of bad debt expense for the year. So that's the amount we journalize. Debit, credit. Debit, bad debt expense, and credit this new contra asset allowance for doubtful accounts. Again, we don't credit the receivable because we don't know which customer is going to go bad, which receivable. So this is just an offset to all of the receivables. The other method of calculating the bad debt expense is to take a percent of the accounts receivable. So here is our accounts receivable at the end of the year, and again we're going to multiply it by a bad debt percentage based upon the company's experience. In the previous method we were multiplying it by the net credit sales, but here we're looking at the receivable at the end of the year instead and multiplying it by a different percentage. Now your answer to this calculation is not going to be the amount you debit and credit. What you're going to do is take that amount you just figured out here, multiplying this out, and either increase it or decrease it by the amount in the allowance account just before making the entry, adjusting entry you're going to be doing right now. In other words, you're updating the allowance account for this amount here. This is the target balance you're shooting for in the allowance account. And here is the amount already in the allowance account before making any adjustment. The difference between the two is the amount of your bad debt expense. So let's take a look at an example here. We have our company Barton has 100,000 in the receivables at the end of the year, and the neighboring adjust allowance for doubtful accounts has a credit balance of 900 at the end of the year. This is before making the adjusting entry. And we're told that 4% of our receivables are going to be uncollectible. So here is the question. What is the bad debt expense? So most people would say, oh, 4% times 100,000 is 4,000. Well, that's the balance we want to have in the allowance for doubtful accounts. But already in the allowance is a 900 positive contra asset balance. So what we need to do is get that 4,000 and put this in the balance where we're shooting for. And now if you look at the allowance account, it already has a 900 positive balance. But this is a contra asset increase with credits. So what we got to do is bring up the balance from 900 to 4,000, or another $3,100 needs to be credited to this allowance account. Here a credit to the allowance account and a debit to bad debt expense. Again, not for 4,000, but an amount to bring up the balance in the allowance to 4,000. So it's always important to know, using this percent of accounts receivable method, what's already in your allowance account. Is it a positive balance? Or it could be a negative balance, where you would take that negative balance plus the balance you're shooting for, plus to get the amount to put in here, just to bring it up to 0 and then up to this balance here. A slightly different way of calculating this percentage of receivable is to do something called aging the receivables. In other words, chopping it up into different age group and applying a certain percentage to those different age brackets. So let's take a look at an example again for Barton. We still have 100,000 owed to us by our customers, but now we're breaking it down into different age categories. So of this 100,000, $64,500 is not yet due, but due to past experience, we say 1% of this will be uncollectible. So we extend, we multiply across. And then this group here of 18,500 is overdue by 1 to 30 days, and they get assigned a higher percentage. Again, this is based upon our company's past experience, and you'll be given these percentages here in any problem for our Chapter 7. So you notice the older they are, the higher the uncollectible percentage. When you extend across, now you foot down. Foot means to add down to get the amount you want to have in your allowance account. And again, it depends upon what's already there to determine how much more you need, how much you're going to journalize as your bad debt expense. So just like before, we start off with a 900 credit balance, and here's the new balance we just had calculated in that aging analysis. So the amount to bring up the balance to this target is another 4,420, crediting the allowance account and debiting bad debt expense. Now make sure you know whether the beginning balance you're working with is either positive or negative here. If it's negative, that means you would add that absolute amount to the target balance to bring it up to 0, and then to the target amount, and that's the amount you debit and credit. Again, using this aging percentage of accounts receivable. Then eventually you're going to write off the receivable later on. So here, just like we've seen before, you credit receivables from customers who cannot pay you off. Now the offsetting debit is not bad debt expense. That was a direct write-off method. But what you're doing is using this allowance you've just set up. Again, going back to the previous screen, you've increased this allowance to take into account that you're going to be able to identify in the future, possibly after this date, not necessarily on this date, customers who are going to go bad. And you're going to reduce the receivable and now start using this allowance you had set up. Yeah, you're using up this allowance with this debit. You're writing off this receivable with a credit. Again, it doesn't have to be at the end of the year, but now it could be any time in the following year, because you've already made the adjustment to set up this allowance in this entry here, yeah, to get to this balance. Okay, let's move on to our next topic. I'm not going to talk about this recovery again since it's not too common. Oh, here's a summary of the ways of calculating the allowance and bad debt expense. The first method was taking a percentage of sales, and whatever the calculation is the amount of the debit to bad debt expense and credit to the allowance. You don't care what's already in the allowance account. Sometimes they call this the income statement focus or income statement method, because sales is an income statement account. It appears on the income statement. Whereas receivables, or the aging of the receivables are an asset on the balance sheet method here. And remember, when you use this percentage of receivables or percentage of aging of receivables, your answer in the initial calculation is the balance in the allowance account, and you have to either increase or decrease it by what's already there in the allowance account, be it a negative or a positive balance. Okay, next main topic is receivables again, but this time represented by a piece of paper called a note. So just like this right here, this piece of paper is a note that has lots of different terms, different conditions when you borrow or let people borrow money or lend money to other people. The person borrowing the money is called the maker, and they would sign off here at the bottom. The person that's lending the money and eventually will get back the money plus interest is called the payee. It looks like it's this Barton company again. So we're taking the point of view of we, the lender. So this would be a note receivable to Barton and a note payable by Julia, a liability by Julia. So here's the date the money is being lent or borrowed, and it's going to be paid off within a certain time period. Here is the term, 90 days. In fact, they have the maturity date here when everything has to be paid back. The amount borrowed, which is called principal of $10,000, plus the interest. Here, stated as a percentage for one whole year. Sometimes they call it per annum. But it's not going to be 12% of 1,000 you pay back or receive, because it's not a whole year loan. It's just for 90 days. The calculation of interest is to take the amount of money borrowed or lent, multiply it by that annual per annum interest rate, and this next factor would be 1 if the time to maturity is 1 year. But most times you'll see it to be less than a year. So we're going to have to change that year to days in a year. And we're going to have a fraction, the number of days to maturity plus the number of days in a year. Now most of us know it's 365, but for convenience purposes in calculation they use 360. So use 360 unless you're told to use 365. So when you multiply all of this out, here is the interest for that term, this term of days. So our example is we have our customer matrix buying a $12,000, looks like a photocopier, from us, the office supply Inc., and we're going to give our customer matrix time to pay off the $12,000, but charging them 9% interest, and they have to pay off the $12,000 plus interest in 90 days. So here's the first question: when is the money due? When does the note mature? So you actually have to break out a calendar and start counting days. So here's the easiest way to do that. Our note is dated March 1st. So this March 1st don't count as part of the 90 days. March 2nd is the first day of the 90 days. So here we take the date of our note, March 1st, number 1, and there's 31 days in that month. So that means there's 30 days left in March. And here's another 30 days of all of April, and that is 60 days. So of the 90 days, that means there's 30 more days left here, 30 more days left. And this is the date. The next month, May 30th, is the date the note is going to be collected, the principal plus the interest. 12,000 principal, the amount of money borrowed or lent, times our annual interest rate for the whole 1 year. But our time is not one whole year, it's only 90 days. And again, the denominator when you calculate this would be 360, not 365, unless you're told to use 365. So for that 90-day period, we're going to earn $270 of interest and also collect the $12,000 we had lent on the sale. The journal entry to record the sale here on March 1st is to credit revenue, $12,000, and not debit cash, but debit the note receivable asset. Not accounts receivable now, because we got that promissory note from our customer. And then 90 days later, here's the money coming in, represented by collecting the note, here reducing the note receivable asset with a credit, and interest earned. This is revenue recorded with credit. Total debits equal total credits. So let's say that matrix doesn't pay us off. We still record the interest on the maturity date. We still reduce the note receivable with a credit. But here we cannot debit cash because we didn't collect it. Matrix owes us this open account, not note receivable, but accounts receivable now. And we try to collect this money. Yeah, we don't give up, easily. So what would happen if this sale took place near the end of the year, December 1st? Well, we still record the sale on the date December 1st, but we won't be able to collect our money until next year. But before next year comes around, here is the end of the year. And if you remember from previous chapters, the end of the year is something special for accountants, right? We get kind of busy because we have to record adjusting journal entries. And one of them is to record the interest we earned on this promissory $12,000 note. Even though we haven't collected it yet, we've earned 30 days worth of interest. So here, principal times rate times the 30-day over a year. We've earned $90 by December 31st. We don't record revenue when we collect it now under the accrue method of accounting. We record it when it's earned. In the case of interest, we earn it over time, 30 days. Journal entry. Record revenue, credit $90, and debit, not cash. The cash will be collected in another 60 days, but that's going to be next year. Here we have the right to receive, receivable, interest receivable now, $90 debit. So when the 90 days are over, here we figured out to be March 1st. Here's all the money we collect. But now you got to remember, you're collecting on three different things. The note receivable principal, we got to reduce that asset with a credit. And here's the interest we had accrued last year as an adjusting entry, reducing that with a credit. And then the interest we're earning this year meaning January 1st through March 1st of the second year. This would be 12,000 principal times, what was it, 9% interest rate times 60 over 90 days. Or again, that same 270 allocated 60 days, 30 days here and 60 days here. Yeah, interest revenue earned, yeah. Not for 270, but only for the 60 days here in the second year. So let's say that you want to not wait to collect your money. So with your accounts receivable, notes receivable, there are some financing companies that are willing to buy your receivables. Here you can sell it to them. We call that factoring. And of course, they're not going to do this for free. They're going to charge you a fee, so you're not going to receive the full amount of that receivable, be it accounts or notes receivable. Or you can use your receivables as collateral to borrow money. Yeah. At the end of every one of our chapters, we usually have some kind of ratio. The ratio here is called the accounts receivable turnover ratio. And it's almost like, let me give you an analogy. So let's say you're driving your car and you want to know how much distance you went. We would look at the odometer reading, how many miles you drove. Well, that would be something comparable to this here. You drove your business for so many sales dollars. More the better you get out of your business, yeah? But we also want to know how fast you drove your car or how fast you collected this receivables. So here in the denominator of our fraction, we would take an average of the accounts receivable. The beginning of the year probably average with the ending of the year. And when you divide that average receivable into the net sales, what you get is the speed, like a speedometer, how fast you're able to collect your receivables. And the bigger this number here, the faster you're collecting, right? The bigger the sales, the smaller the receivable, the bigger the turnover. And what you can do is take this turnover ratio and divide it into 365 days in a year. And the answer would give you how many days it usually takes for you to collect from a customer. The average time it takes to collect from a customer. Again, you want that to be as short as possible. So you want this to be as big as possible. Yeah? Okay, so this is the end of our chapter 7. If you have questions, email me, kamida@hawaii.edu.